Early days, Nayantara. You've seen a comeback in the bank nifty, and IT in a sense is going to get this leg up largely because of what TCS has reported in terms of an buyback. While good old Samir Arora joins us now, we always look forward to our engagement with him. It's about markets, it's about books, it's about his travel in London, where he's been clicking pictures with one only Harrison Ford, and he's been tweeting about it. So, Samir, good to have you back. How did the trip go?
Well, I'm still on a trip right now. I'm in US. So it's been a way of trying to figure out whether WFH means work from home or work from hotels. WFH works as well in both places.
So, how long will this work from hotels will continue?
Well, the whole idea was to do it for 3 months, and 2 months are over. So right now I'm in Savannah, Georgia.
So, what's the sense? So, Samir, when you travel and when you look around, you are pretty much there where we know that the spread of the virus has been strong. But when you look around, meet people, are they scared? Are they worried? Or is it life is back? I mean, life is as
So,
back as normal.
I'm going to New York tomorrow where the cases are a bit more. But in all the other places I've been to so far, which is Texas and South Carolina and Georgia, people are not seeming to be worried. And also the cases seem to be less, plus the crowd here is less. So when you're on the road or when you're in a shop, it doesn't, it's not a big crowd that you have to overly worry about. You just wear a single mask and go in. I think from tomorrow we'll have to be a little bit extra careful because New York is sort of having very high cases. But when I've spoken to people in New York for my meetings and all, everybody seems to be attending office. Nobody has said, oh, sorry, we fixed this meeting a few weeks ago and now please we are not meeting because we are not going to office, or let's do a Zoom call. They are right now.
What's your understanding? Because what view we are getting are from macro experts, and they've been making a case that American economy is growing, but nobody's feeling the feet of inflation. When you are traveling, when you are
Inflation is very high here. Some of it that might help India actually. Some of these doctor guys have moved their business back to India for transcription and all that other things, whatever they can do there. No, because I didn't really meet anybody who's directly on the front line there. But that should solve itself in the next few months, although it doesn't seem to be. Even today, there was an article in Wall Street Journal that houses that are being completed, some of them don't have garage doors, and they are selling these without the garage door, saying, "We'll get you the garage door. Please buy the house without it." So there are supply chain issues everywhere, but still, that might solve itself or might resolve in a few months. But wage inflation is there right now, very high, supposedly.
Good morning, Samir. So you're spotting, of course, Hollywood actors around the world. You've already met with Harrison Ford in London. I don't know if you're going to get to meet George Clooney or Brad Pitt in New York City, but just taking forward what's happening in the US, because 2020 rate hikes, the market's expecting, a bigger binding down of the quantitative easing program as well. Should we folks in India be worried about the flows? Because if the rates go up, will we see flight of capital? What's going to happen to stock prices back home?
Okay, so let's first look at the equity market flows. So in 2021, how much money did we get? We had actually a total FII flow of $4 billion total, in which the secondary market had selling of 7 billion or something. And in primary market or IPOs, they put in 11 billion. So please don't tell me that $4 billion in a year for the stock market directly as an FII is such a big deal and can be explained by liquidity, because in our average for the last 25 years, maybe more than 15, $20 billion a year, including into this data, excluding China, then last year the outflows were $35 billion. If you look at India and say, where has the money come in? The money has come in into private equity and venture capital, and it is highly unlikely that that money, because we are talking about short-term liquidity or 2-year liquidity or 1-year liquidity, that people have put money with 7-year and 10-year kind of horizons, because that is what it would mean for at least VC or a private equity fund initial investment, that is liquidity. So we have not seen any liquidity in our country or even in our region directly. And also, if you look at the market last year, if you forget about India, but the Asian emerging market was down. Emerging market was down. Asia, Japan was down for the year. So I don't believe this liquidity bit beyond a point. But the second thing is that we have seen this story in the past of interest rate hikes, and the initial interest rate hikes are not negative for the market. We saw that in the period 2003 to 6 when there were 17 consecutive interest rate hikes, and the overall hike was 4.25%, and it started from some 2% and went to 6.5% the rate. And then also in 2015 to 19, when again the Federal Reserve tried to normalize and it went from 0 to about 2.5%. So today the rate is like 0.1 or whatever. So if we are going to have 7-8 interest rate hikes over the next 3 years, which means some 4 this year and 3 next year or whatever, 2 or whatever, 3.32 or whatever combo, you are going to go back to 2.5% kind of rate in 2024, the same rate or lower than what it was in 2019. So I don't think this is the issue. This is when there is a change in regime of interest rate, a little bit there'll be nervousness, but they will need to do something more, or the inflation will have to be much higher, or the rates will have to be much more, or the panic for whatever reason, some new reason will have to come in. This one is too well telegraphed and is most justified, I would think, that you have some interest rate hikes.
In fact, the equity markets also have been pretty much shrugging off what we see in the bond markets, right? We saw the 10-year yield top 1.7%. So Samir, tell us, for 2022, should one temper their expectations when it comes to returns, simply because 2021 in that sense was a phenomenal year?
Without a doubt, actually, there is no reason to have very high expectations, because ultimately, whatever we may say, for 2 years, the returns have been above normal and reasonably above, but not massive outliers. So if you look at the last 25-year returns from the Indian market, and let's look at the NSE 500, because that is the one I saw, the last 25-year return is around 15.8% per annum. So last 2 years, in 2021, the returns have been something like 30%. And in 2020, they were something like, I forget, but 15, 18, 20% for the full year. So for 2 years, you've had a higher than normal, but you've not had obscene returns. That may have looked, when you were looking back in, say, April, May 21 over 1 year, it looked like you made 50, 60, 80% return. But once time passes and you include the whole of last year rather than just starting from March, April of 20, then the returns have become sort of higher than normal, but only for 2 years. If you look at 5-year returns from here, for the past 5 years, the returns have been maybe 1% per annum higher than the longer term average. So returns have to be moderate in the sense that you have to remember what is the longer term return. And it still looks that range of return is reasonable. Normally returns around the world are falling. They are not going higher than their longer term averages. But let's say their longer term is 15, and that you can justify either on corporate earnings growth or on GDP growth in nominal terms, which sort of will then lead to the same corporate earnings growth, then you are supposed to expect plus minus this much. And that is how you start. And if you get more, we take it. But you're not supposed to start with 20, 25% expected return unless you are really starting at a super bad time. And therefore, yes, expectations have to be moderate. But we believe that they'll be better than what else you can do with your money, whether putting it in fixed deposit or putting in gold or putting in any other similar kind of investment, financial investment.
This is such a great point Samir has been making, and he made this point I think on the Twitter space also, say about a month ago, which is that you look at not the last 2 year returns but the average returns, and the average returns are indicating that we could be in for a decent 2022. And considering that you're getting 5% in fixed deposits, you're getting very little return when interest rates will go higher in bonds. Bitcoin already has given you flat returns in last 1 year. Think again, where do you want to park your surplus? Samir, let's spend some time trying to understand the IT space. One is business, which we've discussed again and again that it's a multi-year cycle. But now this buyback which is coming every 2 years, whenever the regulations allow, IT companies are doing a buyback, which means that they are shareholder friendly, the return ratios improve. This is a cycle which is in making. How does that change the perception in P multiples for IT stocks because of this entire cashback, dividend and buyback?
So at first level, it shows that the IT companies are similar or better in terms of the tenure of growth than consumer staple companies and still trade at maybe half the valuation that Indian consumer staple companies grow at. But separately, they are at higher than their normal past 5-year range of valuation. But we are overweight on IT on the basis that the real change in the world is all being driven by IT, and whatever is happening in the US, the Indian IT companies are able to adapt and grow along with them, whether it is cloud or security or whatever new things are happening, or even autonomous driving or whatever you have. There's some angle which some Indian companies can adapt to, and in a sense, ride on that. But in terms of whether you're getting the money back as dividend or as buyback, has more to do, I think, with taxes more than anything else. The overall yield is similar over the past many years. So this is an event we have. I mean, TCS is one of our larger holdings, but what I mean is this is it's just another form of giving it back, and so it is not that big a surprise, I would say.
Would you like to make space for let's say a policy bazaar or any of the fintech companies in your portfolio, considering that that's a pure play on technology? It may not be this year, it may not be next year, but these could be the big ones because of the way technology and digital adaptation is moving.
Well, the thing is that, first of all, we are not managing $100 billion that if I feel that something will do well after 2 years, I'm supposed to buy it today because it might do well in year 3. But looking at it today, because we also follow closely the US stocks, if you see the correction in US new IPOs and in US stocks that were trading at multiples of sales, 30 times, 40 times. We own one of them, Snowflake, which I think was starting at 100 times sales or maybe 80 times sales. But mostly others we don't have, but we had this one. So those stocks have corrected a lot, And I have never believed that in India we are doing anything different. Whether it's the IPO or the valuation of the IPO or how it trades, they just blindly follow the US or global markets, and they are correcting the same way. But they can correct all of these or any more, because we won't buy any new ones so easily, are all going to correct. And if over time, when they start doing well as a stock, you don't do badly and then from next day start doing well, because in all these companies there is also a very big overhang of the private equity investor. Please understand that the private equity investors, in some of them, I don't know about each one of them separately, but broadly speaking, there'll be 30, 40, 50, 60% holdings by private equity investors. And we also have seen separately that if you have that kind of overhang even over the next 1 year or 2 years or 3 years, that's a massive overhang and will always put pressure on prices. So there has to be a stage where you feel that all that can be taken into account and it is very good straight away. So I think that will take time. You don't go from underperforming to next day outperforming. It takes time to consolidate, time for new people to come in, for people to understand what these private equity guys will do, because not all of them even had 1 year lock-ins. Some of them in the pre-IPO guys, I think, may have even less lock-in, or maybe it's 1 year, I don't know exactly. But broadly, these things are not going to be resolved so easily when your starting prices are so wild.
When you meet global investors, and I know you track China very closely, how much of a moving story is China? Last year we got impacted on the positive side, given how the Chinese regulations changed. Before that, we also benefited because the Chinese economy, in a sense, was changing its dynamics towards manufacturing.
Okay.
What kind of moving part do you think China will be in 2022?
So now the thing is, there are two conflicting things. One, I'm going to start from day after tomorrow when I am marketing India to the New Yorkers. But the thing is that the strategist guys are saying that China has become very cheap, and therefore on that basis they have recommended, like even Goldman Sachs and I think a few other, Morgan Stanley, everybody saying that India to be market weight or whatever, because China has corrected a lot and therefore it is looking very cheap on this basis, that basis. Our logic is going to be that it is uninvestable, that this is not how investing is done, that you don't know the rules of the game. And secondly, that in any case, if you were investing 30, let's say the emerging market benchmark had some 34, 35% in China and India's weightage was around 12%. So even if with new money on the margin, you put whatever you want to put in China, but if you put 3 or 4% less only, which is 10% less, so 35 becomes 32, which doesn't look like a big deal for anybody to do considering what pain they have seen and how randomly this pain has been given to them, that they reduce it by a few percentage point, then the logical uh, beneficiary of that is India, because that looks like the closest market in terms of what they are thinking when they're buying India, China, which is long term and large number of consumers and economy catching up and all that. And therefore, if we get even 1 or 2% of that, that is for us 10 to 20% more flows. But please understand, when we talk about liquidity last year was shockingly low for India, and it was actually negative for all the others. I mean, to get $4 billion and call it that this is a liquidity driven rally is like, we don't know what liquidity means. But that 4 billion also was a positive because most of the other countries had outflows last year. Asia ex China and India was down some 35, $37 billion. That is Korea, Taiwan, and all these other countries. So a little bit of mellowing down of China, even if on the in aggregate they're putting money, just reshift, allocating a little bit of that allocation would help India. So I think India is going to benefit. India is good in today's situation, both from financial investors' point of view, which is this, and from the corporates wanting to have a little bit at least of a China plus one. They would have realized during the COVID times that it is too risky to have all your supply chain in China, because in last year, March, April, when China was shut down initially, and therefore, because of that, the New York stores did not have new clothes or new apparel or whatever. All those things obviously will play on everybody's mind. So that way also India is benefiting, and that is the reason why there is some, and also this PLI scheme and all that is all feeding together to have some boost to manufacturing in India. And the tax cuts that happened in 19.
Yeah, so let's see what happens in the union budget when it comes to taxation rates. So it seems like it may be, difficult to raise or even to cut. But Samir, just taking forward that point where you said a lot of that capital will come to India, it's advantage India with what's happening in China, and it's already started to happen in the private markets, right? You recently recommended a book on Twitter, The Prince of Silicon Valley, which incidentally costs 35,000 rupees on Amazon if anybody wants to read it. But taking forward that point and what Nikunj was also asking you, on a Twitter space recently with Nikunj, you said you will not invest in an Indian IPO till 31st of March, that you made that promise. Are you sticking to that
No,
promise?
I didn't make that promise. I am just prone to making sweeping statements. So the point is, I thought based on the list that I have that I will not invest. But before that, I didn't recommend Prince of Silicon Valley because that is a very old book from 99 2000. Who cares today what happened then beyond a point? But it was similar in the sense of how corporates, particularly Michael Dell and a few others that were named in that, were putting pressure on Credit Suisse and others to give them for their family offices hot allocations in hot IPOs, effectively in return for business from the companies that they were managing or they were CEOs of. And so it was in that context. But today, please don't buy a 35,000 rupee book. You can take it from me for 20,000 if you so desire an old book that I have in Singapore. So coming back to the IPO, I was saying generally looking at the list that there is no excitement from that time. And actually, you've seen all the IPOs since then, other than some 200 crore type IPOs have all failed in terms of having lower prices. So as of today, yeah, that seems to be the case. But let's see. There's no commitment. We can't commit on behalf of our investors without seeing the next IPO and what price it ultimately comes at. But in a big picture sense, yes, that is true that there is no point.
You talked about manufacturing. We've talked about IT. What about banks, Samir? You know, if you look at the start of 2022, we were all wondering, banks ka time kab aayega? It seems it's arrived.
True. But banks, I didn't talk much because, all our life we have been overweight financial sector and all these HDFC Bank. And fortunately, we had both ICICI and State Bank as our top three. I mean, top out in the top three, including HDFC Bank, which has now become number two because of having underperformed ICICI Bank. Hopefully, it does well and again regains its number one position in our portfolio. But generally speaking, financials, we have always believed these three and a few others, and then NBFCs and the brokerages and so many and housing finance. That there is such a big scope for financial sector penetration. The companies have longer history and they are able to participate and change with whatever is happening. So these guys are all long-term quality guys, including Kotak Bank. So we normally would have kept them all alive. We have them. Last year they didn't do well. I mean, as much as a group, but because of ICICI and State Bank, we were okay. So yeah, that sector we are not going to say that today is good or that. We have been saying that all our life that it is a good sector. And many people, swear on saying that we don't buy financials because they are leveraged and because you can lose money in one day. But reality doesn't happen. Everybody knows which stocks are good and which are bad. It's just a matter of how much weightage you can have and a little bit of your belief in what the underpenetration of, say, financial services in India is relative to anywhere else in the world.
Okay, well, let's leave it at that because that's all the time we have for today. Samir Arora joining us all the way from Georgia and United States. So thanks a lot. You must have stayed up really late to be live with us. We really
it's only
appreciate
11.
it.
Thank you very
Wish
much.
you and the entire team a very happy New Year, and of course, look forward to having you back soon on ET Now.
Happy New Year. Thank you, everybody.
Now let's shift gears literally and talk about a stock from the Motown, which has also got big plans as far as defense goes. Yes, we're talking about Motherson Sumi, where Vivek Chand Sehgal, the chairman, is now joining us live right here on ET Now. The stock is also very much in news as the proposed demerger of the wiring business is finally here. The record date has been set for 17th of January. And as per that, for every one equity share of Motherson Sumi Wiring, you will get for Motherson Sumi share. Mr. Sehgal, thanks so much for joining us live right here on ET Now. Let's begin with the demerger news. It's been stuck at the NCLT for a long time, but now, as we all know, 17 January being set as the record date. Why is this an important event for the company?
Yes, we've been waiting for a long time for this particular clarification from the government and the approvals to go ahead